if we put this year aside and we just think towards future budgets and we wish to avoid being in situations like this again and again as the business cycle takes us in and out of flush times and down times, what would be the one thing that you would like to see change? Would it be the 2/3? Would it be an alteration to Prop 13? Is it something else?
I think Prop 13 is pretty well immutable. It is just one of these sacred elements in California history, and I don't think you're going to be changing that anytime soon. I think what we have to do is essentially, and this is hard work to do, and it's educational, boring type work, is get the legislature and the governor to not necessarily pass another constitutional amendment with formulas and rainy day funds built into it and all of that, but to behave that way. To understand that when you get a sudden windfall in revenue because the economy has gone particularly good, or you've got a jump in the stock market or something like that, that you've just simply got to put that away in a reserve of some type. And you have then at least some cushion when the economy turns down. I think you also have to be prepared to have a kind of plan B in the budget. The thing about the budget that I like to point to is sort of the analogy of being on top of a mountain. When you're on top of a mountain, you're not in danger of falling up. You can only fall down. So the risk is not symmetrical. And the problem with budgets is the same. When the economy is doing well, if things are balanced and you're not having any fiscal problems, the chances are you're not going to fall up. The risk is much more on the other side, that something untoward is going to happen and you're going to go in the other direction. So you've got to build up some kind of a reserve in that period. And even that, you've got, with a healthy reserve, you probably got about a year to correct whatever problem has arisen. You may remember going back until the late 90s, we had the dot-com boom, so a lot of revenue was coming in from the stock market. People got stock options and their portfolios were appreciating and so on, especially here in California where we had all the dot-com companies. And at that time, the legislature went on a spending spree. So by the time we got to the peak of that cycle, we were actually in a slight deficit. So we were at the peak, we couldn't fall up, we could only fall down. Now there was money in the bank because even though the legislature was spending a lot, and even though at the peak they were running a slight deficit, the money had come in so fast that we actually had a pretty healthy reserve. Within a year, it was gone. So a year is about all you can buy, even with a healthy reserve, and then you've got to begin looking ahead. And one way to look ahead is to think about the budget process in two parts. You pass a budget. Budget is always a forecast, so you pass a budget on your best estimate of what likely revenues are going to be and what expenditures and so on. But then you have, in the back of your mind and maybe on paper, a kind of plan B, where we say, you know, if we get 3 or 4 months into the year and it really looks like this was unrealistic and things are not going to work out the way we had expected, we have already thought through what our priorities are and what we can cut, what we have to preserve, and so on, and so we go from A to B. Again, that's tough to do. That's the sort of boring, get up with the charts and the PowerPoints and so on, but that's what we really need to educate the legislature and the citizenry.
Dan, can you explain the relationship between the real estate crisis and the budget crisis?
Well, yes, as you might expect, there are actually a number of relationships. One is that although we tend to think of the real estate problem showing up fiscally as a local issue because it's property values and property taxes and so on, we have kind of linked the state budget in complicated ways, again through this Prop 98 on education, so that if we don't get quite as much revenue going to local school districts through the property tax in a way the state is committed to backfill that. So there's a direct fiscal effect there. But there's also a more indirect kind of effect. First of all, it's affecting other financial markets. We've heard a lot about securities that are based on subprime mortgages, and nobody knows how to value those, and all of those sorts of problems. So that begins to cause financial distress outside the immediate mortgage area, and we're seeing that. And that could directly affect things like capital gains from stock market and other kinds of financial assets. But it also has an effect on economic activity directly within the state. Of course, there is a direct connection to people who are building residential properties. Suddenly that demand is gone, so we're going to be laying off construction workers and people who are affiliated with that sector of the economy. But it also affects people who aren't necessarily in the housing industry per se. There are a lot of homeowners that thought that they were wealthier than it turns out that they are. And if you're in that situation, you might think twice before going out and making some big consumer purchase. One of the scariest budget numbers is not actually in the budget, but the figures for the first 6 months of this fiscal year, so that's July 1, 2007 through December 31st, 2007, is that state sales tax collections in nominal terms for that 6-month period are below what they were for the same period the previous year. So in real terms, of course, the level of economic activity, the level of consumption is even lower. But that suggests that people just aren't going out and buying, and that's going to affect retail and manufacturing and just about every sector of the economy. So when that happens, that affects state income tax collections, sales tax collections. It tends to ripple through the system.
Dan, thanks so much for joining us today. It's been a pleasure speaking with you.
Happy to be here.